Howdy, Jacob here. Today we're looking at Immersion Corporation in the technology, hardware, storage, and peripherals industry, incorporated in 1993. Together with the subsidiaries engaged in the creation, design, development, and licensing of haptic technologies that allow people to use their sense of touch to engage with and experience digital products. Alrighty. Their revenue is actually down from 10 years ago and has been relatively flat for the last 5 years, where margins are 100%. So it looks like they really don't have any cost of goods sold. It's all sales, general admin, R&D, with the most recent years having pretty substantial earnings per share, but pretty volatile business from a margin perspective. And recently, the last 2 years, great returns on invested capital, very little debt, which you can see through their return on equity being the same as their return on invested capital, and through them having a 227 million market cap with just a 66 million enterprise value. That balance sheet shows $160 million of cash-like products with 33 in all of their liabilities. So it's a very safe investment from a balance sheet perspective. And then the cash flow statement has very little capital expenditures, and the last 4 years, similar to their earnings and revenue, have been pretty substantial earnings over here, or free cash flow, with the use of cash being quite a bit in reinvestments. Over here, looks like they made an 87 million net investment into something, 29 million in 2022, and recently paid a dividend. That dividend is 2.5%, and it is about 30%, 30 to 40% of their 5-year average free cash flow, or a 4-year average free cash flow, with share repurchases recently being pretty heavy as well. Let's start making some assumptions on this company. Revenue side, I don't think we're going to be seeing a whole lot of revenue growth, at least based on what I'm seeing here. So maybe 1%. And although they have 1%, they have been reinvesting, and so if they do reinvest at those types of rates, it can be somewhat impressive. So basically, I'm saying they don't have a lot of growth ahead of them, but their ability to turn any sort of growth into earnings and free cash flow is very impressive, historically at least. And so we'll see if they're we'll see how that 14 looks. But to me, it's still less than the market due to the fact that their growth rate isn't there, but it's still fairly impressive in the fact that they can definitely perform better on reinvestments. And then for margins, very impressive margins here as well. This is crazy high. Let's do a pretty wide range, maybe 35 to 45. And then share repurchases, $227 million company. So about 3 million is 1%. Offsetting stock-based compensation, probably 2% a year, seems to make sense. Their dividend pays out 30 to 40%. They don't have a long history of it, so I'll probably just keep that the same. This leaves about 25 to 30% of their money left over to reinvest back into themselves or make acquisitions, or they don't have debt, so not that. But yeah, it just looks a tad expensive due to the fact that I'm just not seeing a whole lot of growth opportunities here. But I think that, if you did understand this business and you were to know that they do have quite a bit of growth ahead of them, or at least, it doesn't even have to be quite a bit. It could just be mid-single digits. I think that this as an investment could be very, very high performing. But for now, just based on the numbers, it looks a tad expensive. So hopefully you enjoy the video. Have a great rest of your day. Thank you.